Good morning. This is Brad Shively from Capital Management Corp. It is Wednesday, April 29th. Really appreciate everyone joining us this morning. And above all, we hope that you and your families are safe and well. Our top priority continues to be safety, health, and financial well-being of our clients and employees. We need 100% of our workforce when needed, 100% of our workforce has complete remote access from their homes. Past investments at CMC have allowed for ease of transition. These are stressful times for society as a whole, for the economy and business, which means the appropriate focus on this call is updating you on where we stand in dealing with and adjusting to the new realities driven by this health crisis. Throughout our firm's 56-year history and through the careers of our investment professionals, we have worked through many bear markets, recessions, and crises. We remain actively engaged with the management teams of the companies in which we invest. Internally, we share pertinent information, knowledge, and wisdom, and have frequent investment meetings. This call is going to be a little different today in that we have gotten a lot of questions from clients as well as prospective clients regarding where we see as a growth model or the growth outlook. What are the markets pricing in? What past lessons should be applied to this cycle? And what does this mean for key investment themes and asset allocation? We will now pass this on to Tim. How bad is it, and what is the outlook for growth?
Well, it was pretty bad. Virtually 20% of the economy was shut down within a month's time, and the New York Stock Exchange experienced its fastest correction and fastest bear market in its 228-year history. The reaction was just as swift and just as historic. Overnight interest rates were moved to zero. Within a week, the Federal Reserve purchased more bonds than it did throughout all of quantitative easing 1, or QE1. Total funds from the first 4 federal government stimulus packages is about $3 trillion. The Federal Reserve bond buying and lending programs could equate to $6 trillion. These figures are about twice that of the entire financial crisis and the Great Recession of 2007 to 2014. Yet, this did not take 7 or 8 years, rather just 2 months. This money will be spent, and it will enter new hands and be spent again, whether it's to pay bills, loans, wages, services, supplies, or shareholders. This money will move through the system over and over again. If the combined $9 trillion of stimulus and liquidity packages changes hands just 5 times, that would have an impact of $45 billion, approximately twice the size of the pre-crisis U.S. economy. This fast response is massive. The economy will rebound, but it will look different. Travel and specialty retail restaurants will not return to 2019 levels for many years. Other areas of the economy, such as healthcare, media, telecom, areas with technological advancements and new consumer trends, should have the best outlooks for growth. By the end of next year, the U.S. will have other problems. What are we going to do with this extra $9 trillion sloshing through the system? And how will the government debt balloon, whether the United States or the global government debt balloon, be deflated? In other words, we'll once again get used to economic growth, and we will find new problems to worry about. And that leads us to valuations. Well, this slide right here, by the way, shows the fast reaction of the Federal Reserve. This is JP Morgan's estimates. We think it will be greater in magnitude than this. So the gray bars on the left are the Federal Reserve, and I think we'll be up closer to the 6 level, not at the 3.5 level. But you see the magnitude and the speed are historic, and we think they'll be even greater when we look back in the future. And then Mark, we're seeing different valuations of different groups of stocks. And how do you see things?
Yeah, thanks, Tim. I'm going to try to answer the question of what has the market priced in. And I guess one important caveat to that is what market. It's kind of a Charles Dickens market to me, where in some cases it was the best of times, and in other cases it was the worst of times. You can kind of see that on this page with performance of the S&P 500, which is down roughly 12% this year. That's as of April 27th, so pretty up-to-date numbers. But the small cap index, the Russell 2000, is still down over 25% for the year, which is unusual to have that sort of dispersion. And perhaps even more unusual is the dispersion between growth versus value. So the large cap growth index is down only 4% for the year, where the large cap value index is down 21% for the year. Certainly we had oil trade at a negative front month contract, so that's down over 100%, at least that contract was for the year. In the bond markets, the 10-year treasury is in the neighborhood of 60 basis points. So the price of those bonds has gone way up, but the future income from those bonds has gone way down this year. So it's a strange market in that the things that have done well are the very, very large technology names, and everything else has really lagged. And you can kind of get a little more granular on the next chart here, where the returns and valuations by style. So the chart on the left side of the page, you can see that large, mid, and small performance, as you move from large to small, you get worse. And then if you go across from left to right, as you go from value to growth, you get better. So you have this situation where large cap growth stocks, which make up the bulk of the S&P 500, the S&P 500 is very concentrated right now with 5 names making up 20% of the index, which is a record, is only down 2.9%. But if you look at the small cap value, you're down 30.3%. So that's really unusual to have that sort of spread. And you can see on the right side of the page, the PE averages for the growth indexes are way higher than they have been over the last 20 years. And the value indexes are a lot closer to kind of their longer term average. So right now we're seeing a lot more opportunities in small cap areas and areas that you might consider value. Now you don't want to just go out and blindly buy small cap value because you want to do your work and know what you're buying. So we're not very excited about the energy area. Oil prices are near record lows for 25 years. A spat between Saudi Arabia and Russia, combined with the lower demand due to the coronavirus, has really hurt oil prices. So we think there's going to be a lot of bankruptcies in that area. So you don't want to go out and blindly buy a fund that might label itself as small cap value, but there are opportunities out there that we're finding primarily within the small caps and primarily within the more value-based sectors. So the growth sectors, the large cap growth, we think although there are some great companies, some of the stock valuations are not as attractive as perhaps they've rebounded more quickly than maybe they deserve to. So that's my perspective on that, and I will throw it back to Tim to talk about past lessons.
Well, this is a long-term chart going back over 100 years, and you see a lot of blips. From the left to the upper right, the returns are around 10% per year, but there have been decades where the returns have been closer to zero. You see that right now we're on one of those blips down, and it feels horrible. All these blips feel horrible, all the blips down. And we get through them one way or another. But you see the causes of many of these previous downturns could involve greater disasters and wars. We don't have that this time. Anyway, your investment team's been through many recessions, bear markets, and crises. While the speed of this bear market's been historic, there are many similarities to previous bear markets. It's helpful to learn from the past in order to have a more accurate assessment of the economy and changing long-term trends. This adds value to asset allocation and security selection. While many recessions can be predicted from financial trends and forward-looking indicators, this recession was event-driven, the spread of the virus. In late 2001, the U.S. was about to exit recession when 9/11 occurred. That created an event-driven extension of that recession. It also resulted in what some call an ongoing, almost 20-year war in Afghanistan. During a recession, but especially during an event-driven period of fear, there can be dramatic mispricings resulting from natural human emotions. In this case, the market moves were even more exaggerated due to extreme levels of financial leverage at some hedge funds. And we made 2 quarterly newsletters recently. The second one, Insight, addressed what we were seeing happen at hedge funds and how that affected a couple of components of the market. We actually think it was quite broad spread, affecting most of the market. Regretfully, we have seen this before as well. Due to the quick and vast wholesale sell-off of stocks and corporate bonds, there are many long-term opportunities that have been greatly mispriced. And many investors are still focused on the short term. Albeit from a low point, we expect to exit recession by this summer due to the reopening of parts of the country and the speedy and excessive stimulus. We did not predict the virus, but we know what to do, and we know what to look for both in recessions and bear markets, regardless of whether they're financially or event-driven. And on the next chart, we'll see what happened after the last recession, and everybody felt lousy. So the bottom of the market was March of 2009, and for the next few years, you could ask around, and most people thought we were still in a recession, or they thought the economy was not growing. But over the subsequent 2 years, the market doubled. And this time we have twice as much stimulus from the federal government and from the Federal Reserve. And we think the recession will be much, much shorter this time around. So this has created opportunities, whether intermediate term or long term. So while others are focused on the short term and day-to-day and sound bites, Mark, would you please comment on the attractive investment themes and recommended asset allocation levels, given what we see today?
Thanks, Tim. So some of these themes are continued where we don't think they will be very upset or interrupted by the coronavirus. Others are new. So we do think there will be both medium and long-term changes due to the coronavirus. So the trend of 5G, we think, is going to continue. It may be delayed 30 or 60 or 90 days, but we don't think that that's going to have a big impact overall of 5G. This will allow people to download things very, very fast and mobily, which is a trend that, 4G was great and people use their cell phones for most things now anyway, at least certain age groups do. So we think this is going to continue, and we've got some investments that we think will benefit greatly from the build out of 5G. Within the healthcare space, medical advancements, obviously everyone is focused right now on treatments for COVID-19 to treat the coronavirus. We do think that this could have a halo effect over the last few years, really since 2015-16. There's been a little bit of political pressure on pharmaceutical and biotech companies as they've been criticized for profits. If you're relying on these companies to cure this disease and restart the economy, we believe that that political pressure will be lessened. So you'll have an impact both from new development of drugs and growth there, but also a little bit of relief from the political pressure, which could be positive. Logistics and distribution is a long-term theme. Internet sales and delivery, this is obviously really ramped up in the last 5 weeks, but that was a trend that was going back years and years and years. As everyone knows, people are more comfortable buying things on the internet and having it delivered to their home currently than maybe going out to the store. And a lot of that had already begun to take place, but this is accelerating that trend. Lithium batteries is a technology that we don't think is going to be impacted. Automakers are going towards electronic vehicles. People have devices in their pockets that need batteries. So this trend should continue. Lithium prices can move up and down and can sometimes track with other energy prices, but we think the long-term growth there is very different from other energy sources where you're actually going to be putting more lithium into things for power in the future and using less traditional sources. So we think that's a great opportunity. Eating at home is a big change. Obviously, with restaurants closed throughout the country, people are eating at home, shopping at grocery stores. There's a lot of trends in that area that have really ramped up. These are companies that had relatively slow growth, probably in January and February, and their growth has very much accelerated in March and April. So we're excited about the trends there. And we do believe that even when we're on the other side of the hill with the coronavirus, the eating at home may have a permanent bump. So we're obviously keeping our eye on that because it's tough to predict the future perfectly, but we do think that these companies can have a longer term benefit. Remote working is another area where we think could have a permanent bump. It'll be interesting. We don't think it'll be to the extent it is now, but remote working should be a trend that continues. And in-home entertainment with theaters closed and other sources of entertainment closed, people have to stay in and they're willing to pay subscriptions to entertain themselves and their families. So that is not changing. And then again, we've mentioned the small cap and value sectors we think are very undervalued versus the rest of the market. And then recurring cash dividends are obviously very, very important. So we've made some changes to make sure that our recurring cash dividends stay where they are. And we think the overall market could rotate into these sectors of small caps, more value-based sectors, not technology, and then recurring cash dividends. And on note on allocation, this I think is a good illustration of why you have to have a long-term allocation plan where your short-term needs should be in cash or very short-term bonds. So if you know you need money for something, it should not be in the stock market in the short term. And the reason for that is the stock market can have unpredictable events that create big drawdowns. And I think we're all keenly aware of that right now, what can happen. So it just kind of underscores the need for a long-term allocation. But if you have money invested for 3 to 5 years and you have cash for the short term, you can ride out these volatile periods. And we do believe that over the next 3 to 5 years, things will be a lot better. Tim did a great job of mentioning all the stimulus in the economy. So when we get on the other side of the hill with the virus, we're sitting in a situation where the economy could ramp back up relatively quickly, perhaps very quickly, due to all the stimulus that's been put into place already. And you could have a market that really goes high, because with interest rate levels below 1% on the 10-year, it really doesn't make too much sense to have an overweight bond allocation. So relative to 2 months ago, we are more positive on stocks and less positive on bonds because stocks are cheaper and bonds are more expensive. And that's pretty simple, but that's what's happened over the last 2 months. So longer term, your allocation, you should talk to your portfolio manager about how comfortable you are with volatility, your age, your income needs, and all those sorts of things. But love to hear from you and talk through those specific allocation needs. But overall, the short term should be cash. Maybe some short-term bonds, and medium term should be shorter-term bonds and stocks. And we do see a better income potential for stocks currently than we do for bonds. So thank you, and I will throw it back to Tim for some closing remarks, and then we'll open it up for questions.
Thank you, Mark. Through history, bear markets tend to end before recessions end. And on average, markets bottom while unemployment is still increasing. Markets tend to bottom when emotions of fear and remorse peak. As states reopen for business, and as the U.S. government and Federal Reserve stimulus funds are felt, money will be spent. It will enter new hands to be spent again and again. Some companies will profit from this, and they're being overlooked today. We are finding opportunities in both the stock and bond market, mostly in stocks. And where there is discretion, we recommend increasing stock exposure and shortening the bond maturities in the portfolios. The stock holdings of more risk-averse and retired investors should be concentrated in the stocks of dividend-paying companies, stocks with long-term growth opportunities, excessive cash generation, and moderate payout ratios. Thank you for joining us today. And Brad, if you'll lead the question and answer session.
Absolutely, Tim. As Tim mentioned here, we're now moving into the Q&A section. Under questions box, you can type in a question that you might have, and we will definitely address it. And we already have quite a few in there in the queue here. So let me just start going through these here right now. Just really quickly here. First question is our growth in, the first question actually is, let's just stress it right here. Effects of the slower growth globally as compared to the U.S., impact of worsening relations with China and subsequent change in supply chain for U.S. manufacturers and retailers, are shifting consumer trends sufficient to significantly change people's habits in the longer term?
So some habits certainly have changed, and it's important to know which ones have changed just for the short term and which ones have longer trends, such as remote working. For some people, that's a longer term trend. They found out it's much nicer than having a long commute. They found out how easy it is with modern technology, and possibly they don't want to go back out and get this virus, even if there are treatments for the virus. It's still pretty nasty. We're all hopeful that schools will reopen one day, and hopeful that's not a long-term trend. But if restaurants can only seat 1 out of 3 tables for spacing requirements and regulations or less demand, more of the food through the system will be used at households and go through grocery stores and chain club sales and so forth. And so we think there is a long-term pickup at some food companies that sell through those channels as opposed to food service. And short-term, there's a big pickup, but long-term, there should be a pickup of over 10%, which is massive for these companies, and it changes their fundamentals greatly. So that's one example of a change that might be continuing. And obviously, not all the changes can be perfectly predicted, but we know with 5G going through the system and with other technological advances, that those will lead to changes. And we know of a few of them, and we know how to profit from some of these changes. So we're very excited about them, and we have a lot more to learn as the new technology rolls out. So there are shifting consumer habits, some from the crisis and some from just technological advances. What's most important is to get the long-term trends correct. What's changed for the long term as opposed to just a short-term blip.
All right, thanks, Tim. Next question. Are there any limitations on the global supply of lithium? Where is it? Who controls it? What, if any, of these factors could affect battery technology?
Albemarle Corporation controls around half of the production of lithium right now. A Chilean owned company, SQM, as well as a U.S. company, Livent, are number 2 and number 3 in the field. And it's important to not only have access to the lithium, but low cost lithium, lithium that's easy to take out of the ground. A lot of that is found in Australia and Chile, where you have you take it out with fluid, and then you have drying ponds, and you're able to get rather good quality lithium there, which then goes to your refining operations. In Australia, there are big reserves. There's a little bit more mining involved with that, and so it costs a little bit more. But those are the 3 largest reserves by country. It's important to be able to refine the lithium to the point where it's more useful and meets the manufacturer's specifications for whoever's making those batteries. And each battery factory would have different specifications. And so it's not only who can produce lithium the cheapest as a commodity, but who can also refine it cost efficiently to the standard needed. And again, those are the 3 companies you would want to watch. The other areas of lithium are higher costs. Others can't refine lithium to a more useful product. And where there's been some excessive venture capital and people going out looking for lithium and looking to make fast dollars, they've seen their funding dry up over the last year, both from the spot market price going down as well as from this current recession and financial fallout. And that's good because it takes around 5 years to bring a lithium find to full production. So to have these startups and venture capital areas stall out and have to start the process over again of funding and permitting, the next 5 years for lithium looks rather bright, where 3 companies will be responsible for most of the supply and most of the refining for what we need for the batteries we want to use and recharge. So it looks like lithium will be the main component of these batteries. It's not that expensive. It's not the most expensive component of the batteries. And so we'll hear about other areas such as cobalt, but we think lithium is where you can make the most money. And we're very excited about those opportunities. But like most good things, it's a long-term opportunity. So you have to put up with the short-term volatility in the meantime, but that can provide attractive entry points.
Thank you, Tim. Next question is regarding comments of rotation to small caps value as well as recurring dividends. are you saying that your future investment focus will likely be in small cap value stocks? Mark, why don't you take this?
I think it's hard to predict what our next buy is going to be, so I wouldn't want to do that. I think I wouldn't want to put too much thought into what bucket things fall into. That's not really the way we think about it. We don't go in thinking, okay, we need a small cap value stock for the portfolio. So I think the valuation makes it that some of those stocks are probably at attractive entry points right now. So I would say that versus a quote unquote normal time in the market, we have a more likely scenario that we'll be investing in small cap value, but it's not like we go out in search of small cap value. So I wouldn't want to say our next buys are going to be in that for sure, but I would say we're probably more tilted towards that currently than we would have been, a year ago or so. So I hope I didn't give the impression that that's what we're going out looking for. I was just remarking on what has happened in the market, and you can look towards that and see where the potential opportunities are. And small cap value theoretically has some good potential opportunities that we're looking at.
One of our requirements is that all of our companies have to have prospects for long-term growth, long-term revenue, earnings, and cash flow generation growth. So we consider all of our stocks internally to be growth stocks, but the market indices, the index makers, they separate stocks in buckets, and the way they separate growth and value stocks is they say the high price to book stocks, the high valuation stocks basically are growth. They must be if they're that highly valued, and the lower valuation stocks or the companies with low price to book ratios are value stocks. And so they just use those quantitative measures to separate growth and value. So if you can find a company with recurring growth that is greatly undervalued, maybe it's in the value index, but maybe in the future it will be in the growth index if you've found the right stock and it not only rises with earnings, but it also rises faster than earnings and gets more expensive. So when we do see the growth indices going up a lot more than the value indices, that means the expensive stocks are getting more expensive and the overlooked stocks are becoming more overlooked. We don't want to own all the overlooked stocks. We only want to own the ones with positive and growing revenue, earnings, and cash generation with strong long-term fundamental prospects. And we prefer strong balance sheets as well.
All right, thanks, Mark. Tim, another question here is alluding to the national debt. U.S. Congress has appropriated approximately $2.9 trillion in 6 weeks. How concerned are you going forward with the debt and the impact on our future outlook?
The debt is massive. It is a long-term problem that will hopefully be addressed. It's politically, it's considered political suicide to address it. What you need is entitlements to be moderated over time, and as well, inflation takes care of part of it, and that if you have 3% inflation for 20 years, that reduces the value of the portfolio or the debt by half. And you need economic growth to build the tax base. It's one thing to increase tax rates, but if your tax base doesn't grow, or if you increase tax rates and your tax base shrinks, you're not really solving the problem. So there are 3 ways to tackle it. Short term, it's not a problem because the Federal Reserve is buying all that debt with its newly printed money. And most of the U.S. Treasury interest rates are below 1%. So as the old bonds that had normal interest rates mature, the government can reissue new debt at a much lower rate. So the cost is not a short or medium term concern, but it is a long-term concern. And there are ways to address it. And we do take that issue seriously, and it does affect how we look at the overall economy and sectors of the economy.
Yeah, this is Mark. To follow up on that, Tim, the interesting thing is you would think with an exploding debt balance, you would have to pay more for that debt than you did prior. And in fact, we found in many cases the opposite is true. So when you have an exploding debt balance, it's because the economy is slowing or you're spending money in an emergency like this one, and people rush towards safety. So you actually have this exploding debt, but your cost of debt remains relatively low. I mentioned earlier the 10-year Treasury is trading in the neighborhood of 60 basis points. That's crazy that you can finance all this long-term U.S. debt, or at least medium-term U.S. debt, for less than 1%. So the government is getting a great deal on its interest rate. And one thing to look for is if the market no longer tolerates this much debt in the system, that means interest rates would have to go up, and go up meaningfully. We just have not seen that. Part of the reason is that all these new buyers in the system and a rush towards safety kind of helps the situation in the short, and that's actually going to be in the medium term too, because these rates are fixed. Obviously, what the government pays on new bonds stays the same, although the values will move up and down. So.
All right, thank you, Tim and Mark. And at this point, that concludes our Q&A session. I believe this certainly has provided a summary of our economic investment outlook here at CMC. Please contact us if you have any further questions or would like to discuss anything that was on this call or anything at all. Thank you again for joining us this morning. We hope that you and your families remain safe and well, and look forward to speaking again soon. Thank you.